Hello there, my friends. Chris Marcus here with you on Monday, August 21st, 2017. And today we have a quick video about the mortgage market, a little bit of an update, and certainly people are thinking about buying, selling a house, whether to rent or buy, and aren't sure how all of these economic factors might play into that. Well, you're in luck today. That's what we're going to go through. And perhaps before that, just wanted to share an important, very important, serious note. That's really that I just feel happy this morning, feel grateful to be able to do these videos, that I get the comments from people that they're finding it helpful, and I think that's part of it, where sure there's some things economically that aren't ideal, but I think any time that we can smile and remember we're right here in one piece, no matter what we might be facing, I don't know. I just think that's a gift that helps get through all the other parts that can feel a little bit more challenging. So I hope you're having a great morning too. That's the point of that. And now, now on to the mortgage market. Basically, well, I'll preface this with certainly like the stock and bond market. To me, it seems like we're in bubble territory, not just in the U.S., but I hear a lot about the Canadian real estate market is insane, Australia, and I'm sure a lot of other parts of the globe, because you print money and it has to go somewhere. Keep in mind, if you think back to the housing crisis, following the dot-com crisis, Greenspan lowers interest rates, and you have, which, again, think of lower interest rates, printing money. And the reason why that facilitated the housing bubble is that normally, you can have people bid up prices, but if there's a finite amount of dollars, if more money is going into the housing market, it has to come out from somewhere else, right? Unless you're printing money, and then you can have these bubbles that get inflated, and you can have prices really go to any level that someone decides based on how much money you print. Again, not an ideal system, but is what it is. And certainly that same pattern has been repeated, perhaps to an even much greater extent following the housing bubble, because it's just each bubble comes and crashes, and then the response is print, borrow, spend faster than ever. My understanding, and again, I'm not a real estate agent by any means, although I have been shopping for a new rental home. I'm not interested in buying a property at this particular point in time for a variety of reasons. Some personal, although some, even if I was sitting there with a big pile of cash, I still wouldn't think this would be an ideal time to buy. And let's briefly dig into why. Again, one of the things that made me think this might be a good topic for today is yesterday I went to look at a place, and the fellow who was showing it to me was, in addition to doing the rental showings, also does real estate sales. And he had mentioned that here in the Denver market, you had a couple of years of things going up at about a 10% clip of appreciation. Although he mentioned that things have slowed this year and seem to be leveling out. And it was interesting, all the things that he was telling me were so reminiscent of what we've heard from the past bubbles, where he was saying basically anything under $500,000, it gets gobbled up instantly. In fact, the competition to buy, especially for those lower price points, is so fierce that people are showing up with cash bids. So even if you're just doing a regular financing, apparently hard to find a place. Again, another thing that I look at is I think in most areas the pricing level is already beyond the peaks before the last crisis. So if you look at 2006, 2007, and we've gone way past there, which, hey, you print $4 trillion, that's going to happen. So in the end, what do we do? Certainly, I think the signs are there that it's in bubble territory, not just in Denver. And certainly here, there's a little bit of a different factor because there are a lot of people moving here each month, especially since marijuana was legalized. Brought a lot of interest here. Although also, it's quite a nice general way of life, I find, especially having grown up on the East Coast in New Jersey. Shh, I'm gonna keep that our little secret. And living in New York for a while, coming out here is very encourage you to come visit. It's just you. Now when I go back to the East Coast, I feel that tension and anxiety of the East Coasters, and I love you guys too. Just God bless you. It just is nice being out here. Things are a bit more relaxed. So yeah, there's that factor that maybe is a little different from some other areas where there is a growing demand and a lot of people coming. With that said, I don't think I would imagine that information that was anecdotally passed along to me yesterday, I think is similar in many other markets. So I remember back in 2009 when I was seeing through all the traditional stuff that was told on Wall Street, and I remember watching one of those Peter Schiff videos where it showed all the stuff he said leading up to the last crisis, and there was one guy that he got into it with who was saying how he thought 10% appreciation, is normal for real estate, which, when you think about it, if the real estate market's going to go up 10% every year, and the cost of a mortgage is 2 or 3%, then really you make more money the bigger house you buy, because you buy $1 million house, goes up 10%, that's $100,000, and you're only paying 2 or 3% in interest, 20 or 30 grand. So by living in the house, you're creating an income, which, again, is a type of thing is doesn't make any sense, is not logically sustainable. Of course, that's the kind of thing that happens with distorted interest rate curves. So clearly, when you look at what's happening and you see the parallels between what happened before the last bubble, yes, I think just like the stock market or the bond market, something is going to have to give at some point. And as far as I can see, well, there are two main likely outcomes. Of course, there's always that chance that something nobody could expect happens, but basically, the way I've been looking at it for a couple years and haven't seen anything that really alters that is you have two primary paths again. The first is that you see a stock market crash, real estate crash, similar, perhaps even more severe than what we saw in 2007 and 2008. Now, if the Federal Reserve really did significantly raise interest rates, and if they either sell all those mortgage and whatever other garbage they have on their balance sheet. Again, remember back in 2008, the Fed bought all this stuff that everybody else felt was worthless, nobody wanted to touch. And that's what we refer to as the Fed's balance sheet. So if they're going to sell this stuff off, you're going to have rising interest rates. You also have to find buyers for this, which, I mean, logically, I can't figure out how they could possibly unwind what they've done without collapsing it. Again, similar to how when Greenspan took interest rates down to 1%, and then he started raising them, all of the people who had those teaser rates couldn't afford the higher payments, which certainly is a very significant possibility this time around as well. How that plays out, we'll see. But again, something similar to 2007, 2008 is a great possibility, especially should the Fed raise interest rates and unwind the balance sheet, which personally I don't think will happen. But at least in that scenario, that's what I would expect. Now, the other scenario that you hear people talk about, if you follow Cliff High, he mentions in the stock market where if you print enough money, again, like we said earlier, you can make price levels go to anything you want. So if the Fed says, hey, we printed 4 trillion last time, we're going to print 20 trillion, maybe the Dow Jones goes up to 120,000, or real estate prices skyrocket again, similar to what we saw with the last batch of printed money following the last crisis. I mean, the stock markets have tripled since then. Well, I would argue that fundamentally, from an economic standpoint, I'm not sure that things are much better, if at all better, certainly not 3 times better than what they were in terms of actual productivity and growth and actual condition and shape of the economy. So, for example, lately we hear the Fed talking about how they're concerned that inflation isn't high enough. They're concerned that you can't pay twice as much when you go to the supermarket, or make it even higher, which again, if that sounds kind of insane, I'm on your side on that one. But nonetheless, in the system we have, the Fed rhetoric, hey, inflation isn't high enough, or if we experience weakness, or if there's not job growth, which again, I don't know that the BLS labor report is anything close to actually measuring the job growth. But we'll set that aside and just assume for a second these are the things the Fed looks at and uses for its decision making. And as they've said for the last 8 years, yeah, we're going to normalize things unless the data is weak, and then we'll print more money. Well, based on everything I can see, the data, unless the Fed prints money, the data is going to look weaker, at least to any degree that it's attempted to be measured realistically in any fashion. So should we have that outcome where the Fed comes out with QE5, QE6, QE7, takes interest rates back down? It really wouldn't even need to take them back down, even just leaving them where they are. I mean, hey, we're still at 1 to 1.25. So essentially, is that much different from zero, given where interest rates would have to be in some sort of normal free market? So basically, the Fed could come out, press the button, and yeah, you could have mortgage prices continue to go up, but not in real terms. So maybe they print enough money that real estate prices double, yet the slice of pizza is $50. In terms of purchasing power, you've actually lost money. And this is why I think the banks love inflation so much, because it's not that easy for people to grasp. But when you can have the real estate price go up in terms of the actual number, but if everything else is rising in price so much faster that you're actually losing value, well, that's what I would expect would happen in that scenario too, where the Fed or the other central banks around the globe, wherever you're watching from. I know we have fans outside of the U.S. now. It's an international show here. So could be some mix of the two. In fact, I still think there will be some, even in nominal prices, which, nominal versus real. Nominal is the actual number. Real prices would be how much you can actually buy relative to the way prices are rising of other things. So perhaps, I guess those are the two main ways things could go, or it could be some combination thereof. And just for the fun of it, I'll call it even an educated guess. But let's say things go the way Chris wants them to. Always nice on those occasions when that happens. What I think is a possibility, or hope for anyway, is perhaps a scenario in which you reach that point in the silver market, or gold market as well, or some of the other commodities, where some of the manipulation is overrun. So you could see, if you're invested in silver, precious metals, you could get a multiple. Again, I do continue to believe that did you not have this large paper short position in the silver market, it's not like silver is worth, it's trading $17 and maybe it goes up to 20 or 22. Again, looking back at 2011, silver hit $49 before it got pummeled in the middle of the night. And we have trader transcripts showing the banks bragging about just selling a ton of paper silver that they don't have. So certainly I think silver in a free market would be well north of 50. And when you actually look at the supply and demand numbers and how distorted it's become, even if the dollar stays in the same relative shape, to see silver over $100 or in multiple hundreds, and again, I understand that this sounds extreme, given something that's trading $17 right now. And normally things don't get this far out of line, in my experience, I guess 16 years in the financial markets. I think things don't normally get this far out of line, except when the market is manipulated. So again, that's why I can understand it sounds extreme, although all I can say is go try and find this, read David Morgan. He puts out a lot of good information about the actual supply and demand. Ted Butler has a good source of information there. When you actually see the numbers, it gets you a little excited, especially if you're a silver owner. So what would be my dream scenario is that perhaps if you had a free silver, reach that point where someone shows up and one way or another the manipulation's overrun and the price of silver goes up, and then perhaps some of the side effects, maybe that triggers people realizing, wait a second, the stock market's overvalued. So could see a scenario where certain assets go up a lot, and then at the same time, or maybe following that, the real estate market gets crushed, bond market gets crushed, stock market gets crushed. So, will it play out in this timing? I don't know. I think it's a great possibility. I would say perhaps even from what I can see, the most likely probability. But you could have that scenario where you win big on precious metals, and at the same time, if you want to buy a house, the prices could experience something similar to what we saw in 2008. So you're winning big on both trades. And that would be the time when I would be thinking more about, all right, maybe it's time to purchase real estate now. Again, does it play out like that? We'll see. Although I'm just very hesitant. If I would be hesitant to purchase, a piece of real estate at these levels now, which again, you can see, back to scenario one, you could see prices just go directly higher like they have, although if that's the result of more money printing, I think in terms of real terms, how much your purchasing power, your home might go up, but overall your wealth will not, because the prices of other goods you buy are rising at an even faster rate. And we'll see how it goes. Could be some mix of the two. But anyway, if you have any questions on this, I know this perhaps isn't the easiest one to dig through, but I think it's worthwhile, relevant, and important, especially if you're thinking about buying or selling real estate. Again, I can't give you any specific recommendations for legal purposes or because I don't know you or your exact situation. If you do need help, there's a link to our website, how you can contact us here at Arcadia. But at least some things to think about that are not what you typically hear from the mainstream news and I think are worthwhile and important. So with that said, leave your comments below. Let me know if you have any questions, and hope you found this one helpful. We'll see you again tomorrow. Thanks.